Hi friends, hope your studies are going well. In this session, we will be dealing with some new accounting standards whereby it has been introduced by the institute coming from May 2024 syllabus. So these new standards will be relevant from the old students' perspective also because the syllabus has got changed, and the new students' perspective also because they will be learning something more, some new accounting standards, and all those things have been placed here. So accordingly, the first accounting standard which we will try to take up from this new syllabus introduction point of view will be in connection with employee benefits. So this is AS 15, which talks about employee benefits. Now, a lot of students have asked me about the revision about this particular accounting standard. So here it goes, whereby we'll try to cover up all the factors related to this. I'll try to explain some of them with examples so that we are able to understand it. And ultimately, let us take up some questions so that we are able to summarize and conclude whatever we have studied from the standards point of view. So you have to concentrate a lot over here. Make sure that from the time we start dealing with this standard till the end, you will not be looking into anything else. You will be concentrating on this standard. Okay. Now with that, let us start up discussing about this AS where it talks about the employee benefits. Now the thing is, whenever we have got the business organization, there will be one person called as employer. There will be one person called as employer. There will be another person called as employee. Employer hires the employee, whereby employee provides services to employer and employer pays some benefit to the employee. Whatever employer is paying here is covered in employee benefits. So that is the mechanism we are supposed to adopt in this situation. Okay. Now the thing is, as employee benefits we are saying payment made for services provided. Services are provided by the employees. The payment is made by the employer. Whatever payment is made is covered by AS 15. Now let's move a bit further. The employee benefits what we are paying, how can they be covered in my day-to-day activity? Now this can be a part of legal agreement, which means let's say that I have a company and I hire you. If you are getting hired in my company, I am going to create one employment agreement. You are going to sign it. In that we will also mention these are the payments we are going to make. Example, we'll pay salary. Salary will be broken up into different things like basic, DA, etc. Then if you perform well, we'll be giving you some bonus, incentives, etc. All those things will be entered over there, and accordingly, as and when you work for my company, I am supposed to pay you because there is a legal agreement. Then law requirement might arise. Let's say there is Provident Fund Act, there is Payment of Gratuity Act, there is Bonus Act. So all these things are from the law requirement, whereby there is a statute, there is a law which is telling us that this is what you are supposed to do. These are the payments you should definitely make to your employee. Even that will also be covered. Then informal practices. Let's say that we don't have any commitment to pay you bonus, say for Dashera. We don't have any commitment to do it. But we have been doing it for the last 10 years. We have been following the same practice and we are paying bonus every year. This year also, it is almost implied that you will be paying it because you have been paying it for the last 10 years. So automatically what happened? There is no legal requirement. There is no agreement between our company and the employees, but we are following a set practice. That practices are also covered over here. It's not only about the legal requirement, it's also about the normal day-to-day practices what our company undergoes. So even that is also covered in employee benefits. Okay, so accounting standard tells us that you got to provide for all these things. The next thing, what is the coverage of this AS 15? How do you cover them? First thing, as the word or as the title itself says that it is employee benefits. But unfortunately, AS15 has not defined who are employees. Okay, because it has not been defined, we assume that everybody will be covered over here. So we will cover all types of employees. First of all, they can be full-time employees, they can be part-time employees, they can be casual employees also. Full-time employees, they are under our employment rules, they will be dealing or they will be with us throughout for a certain period of time. Part-time employees, they might come only for half a day, they are hired on contract basis, etc. Casual, maybe for a particular day. Let's say that I have a factory and suddenly on one day around 30 laborers wanted leave and they went, and if 30 laborers have gone, it is difficult for me to continue the production. So only for that day I hired certain people and I worked with them. Those people will be called as casual employees. No agreement as such, directly hiring, work for the day. Maybe I will hire later if needed, or otherwise I will not hire them. Even that is also covered over here. Then any director payments what we do as employment perspective, even that is also covered. And very important thing, that there is no requirement of formal employer employee relationship. If there is employer employee relationship, it's fine, it's enough. There need not be a formal employer employee relationship. Okay, whereby only direct mechanism will be covered over there, whereby if at all there is a formal agreement, then it is fine. Even if there is no formal agreement, then also it will be covered under employee benefits. Okay, next, the payment can be made in cash or kind. This payment can be made in cash or kind. So just to take an example, the normal salary they pay, the take-home salary, what we normally call the basic DA, etc., that will be paid in the form of cash. Perquisites when they provide, let's say rent-free accommodation is given, I pay your mobile bills, and all those things are employee benefits given, but they are given in kind. You will not be giving cash to them, but instead you give some assets, services, etc. to them. Even that is also covered in AS15. Next, it can be given to employees or dependents. So sometimes nominees, to them we can pay, for legal heirs we can pay, all those people we are allowed to pay. Then it can be paid to employees, dependents, third party. Sometimes even an insurance company can come and we may have to pay them also. They will be dividing it between all the people, etc. But basically any payment is made by employer to employee for services rendered by the employee is covered by AS15. So in general, in specifically we saw what standard tells us, but in general if we look into it, any payment which is made by employer to employee in the course of employment, whereby they give services and we make a payment, is covered by AS15. Only one exception to the rule, it is employee share based payment. The employee stock option plan, what we normally call, that is not covered by AS15. That is actually covered by a guidance note provided by the institute. So here it is not covered. So we will be learning all the payments we make excluding the employee share based payment. The next thing is, when we talk about that formal employer employee relationship, where we said all employees are covered, there need not be a formal employer employee relationship. If at all you are able to establish an informal EE relationship, also AS15 is covered. However, when we talk about that, there will be two contracts through which the work can happen. One is called as contract of service, another one is called as contract for service. Now the thing is, contract for service is basically the contract you have entered to provide a particular service. That can be a professional service, technical service, etc. For a particular service, you are hiring a person and he is going to do that job. Now that is not covered by AS15. It's not covered because it is for that service employer has hired it. Contract of service, which means that person has come to me and is saying that I will work for you for certain number of days for certain number of time. You tell me what I have to do, I am going to do it. Contract of service, that is covered by AS15. For service is a one-time stuff whereby we will provide the service, the job is done. That's not covered here. We will be staying with the company, they will instruct what to do, we will be doing it, and that will be covered as contract of service. So contract of service is covered here, for service is not covered. Next, one of the key statement what we have, this you have to remember when you talk about AS15, the key statement provided by AS15 is cost associated with employee benefit should match with timing of their service. Whatever cost, matching concept what they are talking about, whatever cost we will be associating with the employee benefit, that should match with what services they give. Now, if you think about it, let's say an employee has worked for me from March 1 to March 31. For this, I am paying salary, which means that is March salary. This is simple term. But think about, let's say, pension. Pension will not be paid now. Pension will be paid once the employee gets retired from my organization. But when is that person giving you the service? He will be giving us the service during the employment. Let's say that 1/4/20 onwards, an employee worked till 2050. In this 30 years, whatever services is given for us, he will be getting pension once he gets retired after 30 years. But the services given within this 30 years, cost should also be recognized within this 30 years itself. Not after once you start paying them the pension. Because payment of pension is what you are doing for the services provided in these 30 years. That is the key factor of AS15. So AS15 tells us that when the services are provided, book the cost. That is the key statement what we have to remember. So all type of services what we talk about, at the time of rendering the service, we will accept it, we will record it as expense. In the future, we will make the payment. But recording of expense should happen at the time of employment itself. This is applicable for all types of employee benefit we are going to study in the future. You have to remember this carefully. Next, very important thing of AS15 where we'll be learning all the practicalities now, which is types of employee benefit. Now, AS15 is just telling us what type of employment benefit are there and how are you supposed to record that in the books of accounts. Okay, where the first one will be called as short-term employee benefit, second one is post-employment benefit, third is long-term, and the fourth one is termination benefit. In general, let's learn about these four terms first. Then we will go in detail and start learning how accounting for these should happen. First is, what is short-term employee benefit? Whatever benefits I have derived, the payment to that particular benefit we will be making within 12 months from the end of the year, from the reporting date. Okay, the employee has provided the service. Let's assume that it is FY 2021. So the year ends on 31/3/21. Okay, an employee has given me the service till 31/3/21 during the year. If I am making the payment to these services within 12 months from the end of this year, that will be covered under short term. Say the normal salary you pay, March ka salary you will pay it in the month of April, max you will pay in the month of May, which means you are paying within 2 months, then it is short term itself. Or you can assume bonus also. Bonus of this year will be paid in the next year. If it is profit linked bonus, bonus of this year will be paid in the very next year. If you follow this norm, say 31/3/21 we achieved the profit, we distributed it on 30th September. Now in that case, again we have paid within 12 months, it is short term. So short term employee benefits are those employee benefits where we pay them within 12 months from the year end. What do we mean by post-employment benefit? Once the person retires from my organization, what payment I make is covered under post-employment. So pension is one example, gratuity is there. All these things will come under post-employment benefit. Then long-term. If the payment goes beyond 12 months, then it is long-term. Say the same bonus which I spoke about, instead of the company do not have the tendency of paying the bonus in the very next year, they normally take 2 years to do it, then it comes under long-term employee benefit. So within 12 months if I make the payment, it is short term. That too, please remember, it is within 12 months from the year end. After 12 months or it is going beyond 12 months, it is long term. it is going beyond 12 months, it will be long term. Termination benefit. Now this is basically either employee wants to leave my organization voluntarily, or I am removing that employee due to some reason, say layoff is happening, something like that. At that time, because we are terminating, that person should look for another job, and that will not happen immediately, take some time. So to cover that, we make some payment to them, that will be covered under termination benefit. So either we retrench them, we pay some compensation, that can be covered, or employees will leave it by themselves, voluntary retirement, even that is also covered. So these are the four types of employee benefits what we have. So the normal salary, wages and everything will come under short term. The post employment, where the employment is over, I am still paying my employees because of the services what they are provided during their normal time, that is covered under post employment. Payment going beyond the 12 month, the sabbatical leave and all those things might be covered over there. Then either we are removing the employee or employee is voluntarily retiring, that will be covered under termination. Now we need to learn the accounting one by one. In that, the important ones will be short term and post employment. The other two are normally not that important because it is not covered in the material to that extent also. But these first two are going to be very important because even illustrations are covered in these two topics. Now, short-term employee benefits. Let's start with the first one. I hope till now it is clear. Short-term employee benefits. The thing is, we need to now learn about how do you record that in the books of accounts. For that, there are three scenarios to learn. One is general short-term employee benefit rules and regulations. What if there are short-term compensated absences, and what if there are profit-linked bonus? Okay, short-term compensated absences and bonus, these two have got a bit different rules and regulation. That's why they are categorized separately. But in general, how are we supposed to record our short-term employee benefit? So these are the three things we'll try to study now. The first, in general, what are the rules we have? Whatever employee benefits is there, directly consider that as your expense. I pay salary, salary account debit to bank. This salary is my expense. This salary will be directly shifted to P&L. So whatever we do it, that will be done according to the short-term mechanism. Therefore, entire expense will be transferred to P&L. And that too consider accrual mechanism because that is the normal methodology of accounting we follow. Which means salary incurred matters, not salary paid. So 1 month salary, if it is 1 lakh, 12 month salary, it is 12 lakh. I might have paid 10 lakh also, I might have paid 15 lakh also. Doesn't matter. My expenditure is the one which is accrued, which is 12 lakh. Do not apply any discounting factor. Now by now I think we know the concept of time value of money. So if I am making payment now or if I am making payment after 3 years, have got a different value altogether. So therefore, should I apply time value of money concept and apply discounting factor over here? No need. Why not? Because the benefit derivation period is within 12 months. So therefore, AS 15 said you need not apply discounting factor. So a question might come to us, whether do we apply discounting factor for any of the future aspects? Yes, we will be applying it. So for future aspects we will apply, but right now we need not apply because it's a short-term mechanism. Next, what if the expense accrued and payment are different? Let's say that you have the accrued expense or accrued salary is say 12 lakh, but you paid 14 lakh. What happens? Accrued salary is 12 lakh, but you paid only 9 lakh. What happens? So in that case, if accrued salary is 12 lakh and you paid 14 lakh, automatically you paid 2 lakh addition. Therefore, it will be an asset. What do you call it? Prepaid salary. It will be an asset. On the other way around, if it is 12 lakh, but you paid only 8 lakh, the difference will be 4 lakh, that is less paid. It will be liability. What do you call it? Outstanding. But whatever accrued expenses there will go to P&L. Suppose if you have not paid to that extent, you paid more, it's an asset, show it on the asset side of the balance sheet. You paid less is a liability, show outstanding on the liability side of the balance sheet. That is the requirement in general. Whatever you follow in general, this is what we are supposed to do. Now some specificalities over here. What should we consider for short-term compensated absences? Okay, here you need to concentrate to some extent, so be with me. So short term compensated absences, what are we supposed to do here? Let's say that you are hired in my company and I tell you that during the year you are allowed to take 20 leave. Okay, absences are talking about leave now. You are allowed to take 20 leave and I am going to pay you even if you have taken 20 days leave. You go beyond 20 days, I'll cut your salary, but till 20 days, even you have taken leave, you have not worked to my worked under my organization, then also it's fine, I'm going to make payment to you. Compensated absences, I'm not talking about non-compensated absences. If at all I take a leave, my salary will be cut, that is different. I'm talking about compensated absences, which means I have given you leave, you take the leave, I'll still pay you. Okay, that is the situation applicable over here, which means employee takes leave with payment. Okay, now I have told my employee that you have got 20 days leave you can take, and whatever leaves you take, I will compensate you. I will pay salary, no salary will be cut. Now the employee will ask me one question. He will ask me whether if I take the leave now, then the leave gets closed off and the job is done. If I don't take leave, can I carry it forward to the next year? Okay, let's say that I want to work now. I want to work in this year now. I want to take leave in the next year. Can I take it forward to the next year? So just for our example, 20 leaves is what I have told you. Employee is asking me one scenario now. I don't want to take leave. Can I carry it forward? We call that carry forward mechanism as accumulating compensated absences. I am not allowed to carry forward non-accumulating compensated absences. Okay, let's start with the first, but that's how it will work. So 20 days, if it is accumulating compensated absences, what happens? You don't take a leave in this year, that will get carried forward to next year. However, you take a leave now, but it is not allowed to be carried forward, then it will be non-accumulating. Okay. Now, accumulating, what is the meaning then? Leaves are allowed to be carried forward. You are allowed to take it over to the next year. In that case, what happens? In that case, there are two subdivisions which takes place. One is called as vesting, the other one is called as non-vesting. So what are we studying now? I have not taken leave. I am allowed to carry it forward to the next year. If I am allowed to carry it forward, what will be the nature? The nature will be either vesting nature or it will be non-vesting nature. Now what do you mean by vesting nature? Vesting nature means you have carried it forward to the next year. Now you are saying, I will work in the next year also. I will not take leave, but I will work in the next year. Even if I do this, am I allowed to get some cash in that place? Instead of me taking leave in the next year, am I allowed to take cash equivalent to that particular leave? That will be called as vesting, where the options available in vesting are take leave in the future years or take the cash payment. It's left to you. In the original example which I spoke, let's assume that in year 1, he has taken 5 days leave. Out of the total 20 days, he has taken 5 days leave, which means 15 days leave carried forward to the next year. Now, out of this 15 days, he has a choice. Either he can take extra 15 days leave in the next year or take cash equivalent to that matter. Let's assume that his per day salary is 1000 rupees. So 1000 rupees per day salary, 15 days he is not taking the leave, multiply, that much cash will be given to him. That will be covered under vesting way of accumulated absences. What do we mean by non-vesting then? Vesting means you are allowed to take leave also, you are allowed to take cash also. Non-vesting means I will not pay you any cash, only take leave. I can't pay you cash now. Okay, if you have not utilized the leave in this year, go to the next year, take leave, but don't ask cash from me. That will be considered under non-vesting. Okay, but if you think about it, the normal salary will be paid to this person if he takes leave. If he doesn't take leave, at that time, let's say for example, year 1, as I have told you, out of the total 20 leaves, he have taken 5 leave. which means 15 leaves is carried forward to next year. So year 2, he has his original 20 leaves also, which is that year's 20 leaves, plus he has 15 leaves carried forward from the next year. So there are two things: current year 20 leaves, previous year carried forward 15 leaves. He has both of them which he can encash now. If it is vesting this for this 15, let's assume that the carried forward period is restricted to 1 year. After 1 year it will be lapsed. Let's assume that it can be carried forward to second, third, fourth year also, depending upon the contract what they have. But for the time being, let's assume that year 1 can be carried forward to year 2, but after that it is not allowed to be carried forward, it will be lapsed. That is our assumption. Okay, now in that case, when it comes to vesting option, what will happen? This 15 leave, if he takes it, then he has taken the leave, the job is done. If he doesn't take it, then he will be paid cash. Correct? That's how it works. But understand that key statement what we spoke about. What was the key statement? Record the employee benefit expense or recognize the employee benefit expense at the time of providing the service. Think about it. Year 1, he took only 5 days leave, he has 15 days leave, which means that he has worked for extra 15 days. He was not allowed to work, but he still worked for 15 days. That is getting carried forward to next year. So when the services was rendered, the services were rendered in year 1 then. Therefore, this whatever we are talking about, whatever payment might arise, or he takes future leave, etc. Because if you think from year 1 point of view, if at all the total working days in the year, let's assume 365 days, he worked for 360 days in year 1, okay, and he has got the potential to work only for 330 or 340, no 330 days. He has the potential to work only for 330 days in year 2 now, because he has got this carry forward in total 35 leaves. So therefore he is working extra in year 1, he is working less in year 2. In the year in which he works, record the additional cost. That is the point. In the year in which he works, you need to record the additional cost. This additional cost will be adjusted in the next year when he works less. Okay, so year 1 he worked more, that's why he got that carry forward mechanism to year 2, which means if he wants to avail that benefit, he will be working less. So therefore, in the year in which he worked more, record more expense because he gave more services to you. In the year he worked less, record less expense because he worked less for you. Okay, both the year the payment of salary will remain the same, assuming no increment. Both the year the payment will remain the same, but because that is what we have promised them. But the thing is, recording of expense depends upon not just about payment, it also depends upon the services taken. That year 1 is more, so record additional cost there. Year 2 is less, adjust that in the next year. That is the requirement over there. And now let's learn a bit deeper. If it is vesting, the benefit in year 2 will be taken for sure. Either the benefit in the form of leave will be taken, or the benefit in the form of cash will be taken. It will be taken for sure, 100% they will avail the benefit in the next year. Which means, in case of vesting, you need to recognize full additional cost in year 1, which gets adjusted in year 2. I hope we are clear. 15 days, the example which I gave you, 15 days, if I take the leave, I availed the benefit. If I don't take the leave, I'll get cash. Which means employer point of view, he will be definitely providing some benefits to the employee. Therefore, in year 1, because he has taken the service from that particular employee, provide it fully. Year 2, you adjust that. But when it comes to non-vesting, the only option the employee has is to take leave. He will not be giving cash. Which means in the next year, you don't know. In the next year, that person might even resign from the company, or he may not take leave. He is a very hard working employee. He may not take leave at all, or he will take very minimum leave. Out of 15 days, he took only 5 days, which means the rest 10 is lapsed, assuming that only 1 year carry forward is allowed. Now, in those scenarios, there are chances that he may avail the leave, he may not avail the leave. At that time, you can do it on estimated recognition. let's assume that he might take only 10 days leave out of 15. So recognize only 10 days additional cost in year 1, adjust that in year 2. Okay, suppose sir, he has not taken 10 in second year, he has taken only 8, chalega. It is just that you estimated in year 1, you are now re-estimating in year 2. Changes in accounting estimate, that is allowed. Okay, so that's how the short-term compensated absences should be studied. So quick understanding, short-term compensated absences, accumulated is what we have studied. Accumulated, you are allowed to carry forward the leave. That is further divided into two. One, you are vesting it, which means either you will take cash or you will take future leave. If it is non-vesting, you will only take future leave. Both scenario, 1 year you will work more, the second year you will get the benefit. Therefore, in the period in which you worked more, book more expenses. In the year you work less, book less expenses. Adjustment will be done in between. If at all it is vesting, you will have to consider full additional cost. In non-vesting, you will consider estimated additional cost. What if it is non-accumulating? This has to be the easiest of all. Best example is maternity leave, whereby you will not be allowed to accumulate the leave. At that period, you are allowed to take the leave, which means there is no carry forward, no additional expense. So no need of recording any additional expense. Whatever salary we spoke about, that itself will come into the picture. So this is about the compensated absences under short-term employee benefits. I hope it is clear. If at all you find that it is running, at that time go back and again play it so that your mind will be accustomed to what factors have to be followed. The next thing is about bonus. So this bonus is mainly considered as profit linked bonus, whereby if at all the company earns profit, they may promise to the employees that will pay you certain amount, and that will be called as bonus, incentive, additional payment what they make. Now bonus is allowed to be recorded in the books. Bonus needs to be considered to be recorded in the books if two conditions are satisfied. One, there is a present obligation, which basically means that the company has achieved the profit and the company has achieved the desired profit. In that case, we will consider the bonus to be covered under present obligation, and there is a reliable estimate. Reliable estimate, they normally has a formula to do so. For example, they say if we achieve this much of profit, let's say we have achieved 10 crore of profit, then out of that 10 crore, 1% will be paid to the employees, or say 10% will be paid to the employees. So in this way, they will specifically tell the rate of bonus they pay, and that is basically the reliable estimate. But now we are also supposed to consider whether there is present obligation or not. That is basically whether the company achieved the profit level or not. In this way, if there are any other mechanism through which bonus will be paid, these 2 points we have to remember, that there have to be a present obligation and there have to be a reliable estimate. In those scenarios, we will be considering our employee benefit expenses. So this ends our discussion on short-term employee benefit, whereby we had got some general rules we studied, where we said it is expense which should be transferred to P&L. Payment, if there is any mismatch, then it is asset or liability. Then specifically about 2 things, short-term compensated absences, accumulating, non-accumulating, etc. Then about bonus. So these 3 from the accounting perspective comprises the factors to be covered in short-term employee benefits. Now the most important one, which takes us some time to study, will be considered or will be covered in post-employment benefits. Most important from the AS 15 point of view, because if a question comes, you can easily say that the 70 to 80% probability will be on this itself, where institute wants to check whether you know how to do this thing or not. Now, post-employment benefit, as I have already told you, it's about once the employee gets retired from the organization, you need to record it in the books of accounts. But again, remember the key statement. Key statement said you need to record the expense or cost when you take services from the employee, which means you are taking services from the employee now, but you are paying them once they retire. Because you are taking the services from the employee now, record that in the books also now itself, not when you start paying them. So therefore, that is the factor what we have to adopt when it comes to post-employment benefit. You pay them after a certain number of years, but you take services in this period. Therefore, you need to record the expenditure in this period itself. Okay. Now, how do we record this kind of expenditure? How do you consider the post-employment benefit? There are two ways in which post-employment benefit can be recorded. One, we call it as defined contribution plan. The second one is called as defined benefit plan. Okay. In that, defined contribution plan is easier. Defined benefit plan is that area where we have to study more, where we have to learn a lot over there. Now, defined contribution plan. In this, what is supposed to happen? Employer directly contributes to a separate fund. Okay, let's say that a fund has been provided by LIC and I pay contribution to this LIC fund, and I tell my employees in the contract itself that your post-employment benefit will be taken care by the LIC fund. Now, at this point of time, as an employer, now who will record the expenditure? The employer will record the expenditure, correct? Which means as employer, now imagine what is my job? My job is only to contribute every year. That's it. I will not be checking how LIC will work, where do they invest, how do they pay to the employees. No, I'm not bothered about it. My job is only to pay the contribution every year. There is a market change. Who will bear the risk? The fund will bear the risk. There is a change in investment pattern. Who will bear the risk? The fund will bear the risk, not us. As employers, my job is to contribute, finish it off. That will happen in defined contribution plan. Our job is only to contribute. So therefore, there is no obligation to the employer after the contribution. How are they working? What is the risk associated with them? Nothing. It's their lookout. They have to take care of it, not us. Okay. Then between employer and employee, when they talk about it, how do they speak about this? Employer will tell the employee that I will contribute this much to the fund. Once it is contributed, what is the ultimate benefit the employee is supposed to collect? That is not my lookout. That is unknown. That is between the fund and the employee. I am not involved, or I am not entering that particular part over there. Example, if we maintain statutory provident fund, even provident fund, once they retire, a lump sum amount will be given. So if I consider statutory provident fund, at that time the fund is maintained with the government. My job is only to contribute this to the statutory PF. After that, the PF authorities will take care of it, not us. So that is supposed to happen in defined contribution plan. Once I contribute, my job is done. I will not be looking what happens after that. So I will define what I will contribute to the employee. Once I contribute, how much do they collect at the end of the term? I don't know. That is between the employee and the fund. Okay. This is about the defined contribution plan. Now, how do you record this contribution plan then? Again, same like short-term employment benefit. Whatever contribution I make is my expense. Okay, this year you work for my organization, which means it is my duty to pay you once you retire. Therefore, in your name, I have contributed 50,000 to the fund. Done. That is my expenditure for this year. Okay, no additional factors will be covered here. Directly, whatever contribution I make, contribution account debit to bank account. Done. I will make the contribution. This contribution will go to P&L, employee benefit expenditure. Okay. If at all the actual payment is greater than the contribution, let's say that the contribution to be made every year is 1 lakh, but I made 1,20,000, I made additional contribution, then it is a prepaid contribution, so asset, just like the old stuff. If the actual payment is less than contribution, then it's a liability because it is outstanding, I have to pay a bit later. So this is about defined contribution plan. No complications as such. Whatever we contribute, that is our expense. Once I contribute, it's not my lookout. The fund will take care of it. What will happen in defined benefit plan? How do we consider the defined benefit plan now? Okay. Now, the contribution made and the fund maintenance both will be taken care by the employer. So employer will take care of both the contribution and the maintenance of the fund, which will be paid at the end to the employees. Everything will be taken care by the employer himself. At that time, how do you record the expenditure? Okay. Therefore, the employer has to bear all the risk. where one of the risk will be actuarial risk, the other one will be investment risk. Currently, don't worry much on this. I will start explaining you a process through which you can understand them. At that time, I will talk about it. Then in defined benefit plan, what amount I pay to the employee is known. I will tell my employees saying that whatever was your salary, I will pay 25% of your salary for how many years you have worked for me as post employment benefit. 25 years, 25% I will pay, and let's say you have worked for me for 10 years, last drawn salary is 1 lakh, so 1 lakh into 25% for 10 years I will give it to you as post employment benefit. So I have defined what I am going to pay once the employee retires, but how much contribution will I make to make this payment, that is my lookout. I will not tell that to employee. I will only tell him that I will pay you 15 lakh once you retire. How do you arrange this 15 lakh? You need not ask me. I will take care of it. My job is to give you 15 lakh at the end. Okay? And with the risk factors involved, the employer will take care of it. This is how defined benefit plan will work. Whereby the fund is also with us, which means there is an obligation for me to pay in the future because I am only maintaining it. I have supposed to pay to the employee, which means there is a liability involved over there. Then even an asset will also come, which I will explain. So all these maintenance has to be made by the employer himself. Okay, this is the requirement of defined benefit plan. Now let us take some time and let us learn some factors over here so that it becomes easy for us to apply that in the standard and learn them. So I will take one example in this regard. Let's assume that there is an employee. He has joined my company. So let's say year 1 beginning. In this year 1 beginning, the salary which I have decided, let's assume that it is 5 lakh. 5 lakh is the salary I have decided. And I have told my employee that once he completes 4 years, let's assume that he will be staying with my company for only 4 years, I will pay 25% for number of years of service based on last drawn salary. Okay, this is the promise which I have made to my employee, saying if at all for our learning purpose, 4 years will not be the time for which the employee will stay. He might stay for 20, 30 years also. But for learning purpose, let's assume that he will be staying with us for 4 years and 25% of number of year of service he has worked based on the last drawn salary. So whatever last salary he draws, on that basis I am going to pay him certain number of amount. That is my post-employment benefit. Okay. Now the thing is, let's start analyzing how do we deal with this now. So basically 5 lakh is his current salary, your beginning salary. Okay. Then last drawn salary he will be paid 25% 4 years. Okay. Now this is the mechanism what we have adopted. In between what will happen, so there is year 1, year 2, year 3 and year 4. So there are 4 years. At the end of 4th year, I am supposed to make the payment. This is the scenario, correct? Now the thing is, I want to know how much salary will I pay him at the end of 4th year, because on the last drawn salary, this all calculations are done. Correct? Which means I have to ask my HR team. That is not enough. I have to check what is the market changes which takes place, because I have to apply that also to my organization. So there are many estimates we are supposed to make. Estimates are not just one. How many years he might work? Here I told you 4 years, but that is not the case. How many years the employee might work? Sometimes during the period of employment itself, some employees may die. Suppose if at all there is inflation involved, then what should be our increment rate? Because inflation is happening at 15%, but you are giving only 3% increment will not suffice. All these factors are there which needs to be estimated. We can't do that. We being accountants can't do that. there is a separate dedicated person for it, and that estimates will be done by a person called as actuary. He is the professional who is well versed with this particular aspect. So a lot of elements or a lot of situations requires the actuarial services. Here also is one of the cases where we will be taking up the actuarial services. So there is a separate national level exam for this, and they are qualified enough to do so. So they will be doing all the estimates, and they will be giving us some final conclusions that we have to adopt. Okay. Now actuary said, let's say that actuary said he will work for 4 years. We know this fact. And actuary said give yearly increment to the extent of 10%. Okay, give 10% or let's say 20%. Inflation is more, so let's assume 20%. Give 20% increment every year, and he will work for 4 years. This is what they have told us. Now, based on this, can we make the calculation of last drawn salary? Yes. We are in year 1 beginning, that is 5 lakh. By the time we come to year 1 end, there will be an increment applicable of 20%. So it will be 5 lakh plus 20%, which will be 6 lakh. Now when you come to year 2, this is year 1. When you come to year 2 end, another year have passed. Again I have to add 20% to this. So this turns into 7,20,000. You come to year 3 end, I have to add 20% to this. So let's take a calculator. 7,20,000 into 20%, which leads to 8,64,000. Then year 4, which is the final year for which we have to make the payment, again plus 20%. We get 10,36,800. Okay, you can also have a calculator and have a look into this. So 5 lakh is my initial salary I decided. 20% increment applicable for every year. We added up. We got the last drawn salary as 10,36,800. What have we decided? On the last drawn salary, I have to pay 25% for number of year of service, which is 4 years. So for 4 years, 25% I have to pay. So 10,36,800 into 25% into 4. 10,36,800 into 25% into 4 years will again come to 10,36,800 itself. Okay, suppose if you take 30% and all, the value will differ. Here it is divided by 4 and into 4, therefore we are getting the same value. So basically 10,36,800 is the post-employment benefit I have to pay to my employee once he gets out of my organization after 4 years. But what is our key statement? Period of service, record the expenditure. What is the period of service? Period of service is year 1 to year 4. Which means in this period itself, you have to record 10,36,800. So therefore, what is the period we have? We have a total of 4 years. So 10,36,800 divided by 4 will be recognizing 259,200 every year. I hope till here it is clear that whatever we decided to pay, that will be paid after the employee gets out of my organization. For that we have to provide now only because we take the services now, and therefore whatever post-employment benefit I am supposed to pay him, I will provide 259,200 every year. But again we have to learn something more. 259,200 basically should be provided for all the 4 years. So year 1, year 2, year 3 and year 4. So 259,200 in all years if I consider, once you gather this up, you will pay 10,36,800, which is correct. However, 259,200 what you are keeping aside in end of year 1, will you be paying it in the very same year? No, you will be waiting for 3 more years to do it. This is year 1 end, correct? and this will be year 4 end, which means there is a gap of 1, 2 and 3 years. So there is 3 years gap. From year 2 if you consider, there are 2 years gap. Year 3 if you consider, there is a 1 year gap. Year 4 end you are going to pay the actual. So therefore you need to apply the concept of discounting. Time value of money mechanism comes into the picture. So because the time value of money concept is applicable now, I hope we understood why we are supposed to do it. Because whatever amount we are keeping aside is done on equal mechanism for all the years, but the payment will be done at the end of a particular term. For that reason, if I am keeping it aside right now, why should I keep the full money? I will keep, or I will apply the discounting factor and I will only keep the discounted amount. That will run for those many years to get the final valuation. Okay. So this is the discounting factor applicable. Again, who will tell me the discounting factor? I will again go back to my actuary, and actuary said let's keep the discounting factor as 10%. Okay. So what we'll be doing then, instead of keeping aside 259, 200 every year, I will be now multiplying with discounting factors to get our final conclusion. How do we apply the discounting factor? I need to apply 3 years discounting factor. Here 2 years discounting factor, 1 year discounting factor and nil discounting factor. Reason being, last year, that year itself you have to pay. So no discounting, because whatever value you have set aside, that will be paid. 1 year previous to that, only 1 year gap is between my payment date. Therefore, one discount. Then it goes on for the rest of the years. So if I have to calculate the discounting factors quickly, so 3 years discounting factor. So this will be 0.751. 0.826, then 0.909. This will be 1. So multiply this now. 259 200 into 0.751. This will be 194. 194 660. Second, 259 200 into 0.826. This will be 2,14,100. Then 259 200 into 0.909. This will be 235. 235 613 and finally 259 200. This is how yearly contribution will be made. Okay, I have to pay 1036 800 at the end of the period, at the end of 4th year. That will be provided right now because I am taking the services now. So equally I distributed between 4 years, and if at all I need to provide it in every year, at that time we have to be careful because time value of money concept will apply, discounting should be done. And once you do that, you will be now applying it to pay the final value after 4 years. Whatever yearly payment you are making here, we call this as current service cost. Okay, we'll call this as current service cost. So whatever yearly contribution we are making them. So let's try to learn how the fund will run now. So year 1 end, you will be now contributing 194. You will be contributing 194 660 to the fund. That will itself will be the balance for year 1 end, because at the end of every year you will be contributing. Year 2 end, when you come there, or year 2 if you imagine, first there will be an opening balance in the fund of 194 660. For this we will add interest, and that interest rate is 10%. So it will be 19,466. Then current year I am going to contribute, which is 214,100. So if I take the total of this, 194660, 19466, 214 100. So we get 428 226 as year 2 balance. Now if you analyze year 3, when you come to year 3, now the opening balance is 428 226. Again there will be interest factor 42 823. Then that year current service cost, which is 235 613. So 428226, 42823, 235 613. We get 706 662. Then when you come for year 4, opening 706 662, add interest again at 10%, so 7666. Then add current service cost, which is 259 200, correct? Yes, so 259 200. Take the total. We get 1036 528. We need 1036 800, that is interest appropriation what we have. So if we consider the full valuation, so adjustment will be made towards interest, so that we'll get our total fund which can be paid off. Okay, but this is how it has to work, which means if you are understanding two scenarios now, so two things came up. I have the current service cost which I will be incurring every year, and that current service cost, since there is a period gap, there will be interest, correct? So therefore both this interest and current service cost will be a part of P&L. This is my liability. At the end of 4th year, the liability will be debited, the bank will be credited, and we pay it off. Okay, so how are we getting the liability then? Currently, till now whatever we have studied, the liability balance how we got is opening. For that we added interest and we added current service cost. Till now I hope we are clear. Now the thing is, when we are talking about one employee, these calculations are made, and I hope we got it understood as to how DBO gets created. Defined benefit obligation will be created. The liability will be created basically. But if at all you have got 100 employees over there, each employee will be having a different span. Each employee will be retiring from my organization on a different date. All those things will come, which means during the year, let's say if 5 of the employees have got retired, I have to make 5 employee ka payment. If I make the payment to them, my liability will reduce to that extent, which means if I pay any benefits to the employees, then it will be liability account debit to bank account. Therefore, if there are any benefits paid, that will be deducted. Okay, so last year we called the actuary. He came in, he worked out, he took up all our estimates and he calculated a liability. Next year came up, again he will take up all the current scenario, and accordingly he will ask us to create a liability, which means the actuarial report itself will contain what should be the closing liability value. Okay, the actuarial report will itself contain what should be the closing liability value. For example, let's say opening balance of the liability is 5 lakh. Okay, then interest rate, let's assume 20%. And during the year we paid benefits to the extent of 80,000. Then current service cost which will be applied, let's say, is 1 lakh. Okay, the actuary himself will tell us the closing balance of the fund. What should be the closing balance? Because last year he came in, according to last year's circumstances, he said this is the liability I have to maintain. Based on this year's circumstances, again he will tell what we have to maintain. So accordingly, closing balance this year, he told us that it should be 6,50,000. This is what actuary has told us. Now accordingly, how will we calculate then? 5 lakh is the opening balance. Then I will add interest to this 20%, so 1 lakh. I add current service cost to this, which is another 1 lakh. Then I deduct benefits, which is 80,000. Okay, this has to be the scenario. But closing balance is already defined as 6 lakh 50. Okay, now let us take the final value. We get 6 lakh, 7 lakh minus 80,000 is 6 lakh 20,000. According to our calculation, it is coming as 6 lakh 20, but based on the current circumstance, the actuary is saying maintain 6 lakh 50. Okay, why actuary is saying like that? The assumptions might change, or the underlying principles might change. Any reason. Let's say that we hired more than proportion. Actually, in the previous year thought that we might hire only 30 new employees, but we hired, due to expansion, we had 80 new employees. Now these kind of things are very common because actually cannot give you the perfect estimate. Because of that, based on that year estimate, he will calculate that year closing balance. But that may not match with my calculation. Whatever difference we get, we call it as actuarial gain or loss. Actuarial gain or loss is the scenario whereby if there is any profit or if there is any change in the way in which actuary looked into it, that will be recorded over here. Okay, that will be considered as actuarial gain or loss. So over here, if you look into it, 6 lakh 20 is actually the closing balance we should have, but according to actuary, you need to maintain 6 lakh 50, which means the liability is increasing. There is a 30,000 actuarial loss. Suppose if the liability have to reduce, it will lead into actuarial gain. Okay, so therefore, in the original way of calculation which we looked into it, it will be plus or minus actuarial loss or actuarial gain. Plus actuarial loss minus actuarial gain. Loss will increase my liability value, so therefore it is add. Gain will reduce my liability, therefore it is deduct. So this one more factor got added up over here. Okay, so till now we understood. So there is current service cost, CSC. Then we have interest factor. These two things will go to P&L. What should we do with actuarial gain or loss? According to AS 15, it should be immediately transferred to P&L. So even this is also a part of P&L now. Okay. Now what we are talking about, I hope till now we are able to follow this. What we are talking about is I have to pay after a certain number of years to my employees. And there is an obligation for the employer to pay it, and therefore there is a liability for making the payment. Just because you created the liability, whether cash will come to my organization, no. Liability is only representing that this much of obligation I have it to pay to my employees. But you need actual cash to make the payment. For that reason, AS 15 said also create an asset. And in AS 15 language, we call it as plan assets. Which means how much obligation I have to pay to the employees in the future, set aside some money and invest it in different assets so that you will get money at the end of the term. Use this money to pay off the liability. Which means if I'm paying the liability, the entry will be liability account debit to bank account. Before I do that, what I will do, I will sell off the asset, bank account debit to asset account. So first you will sell off the assets, you will get money inflow, use this money to pay off the liability. So that assets maintenance is called as plan assets. How much asset investment should happen, what expected returns might get, everything again will be said by actuary himself. Even this is also given by the actuarial report, whereby we will create the required investment what the report is telling us. Which means how do you run this asset also? There will be opening balance to this plan assets. For that, returns will come in, interest will be received now. For obligation you have to pay, but for assets we will be receiving it. But add returns. Now that is basically expected, because at the time of investment we expected 10% return, that expected returns will be added. Suppose if I make further investment, so add the new investments which we make in this year. If at all I pay the benefits out of it, so if benefits needs to be paid to the employee, what I will be doing, we will be selling off the asset. So therefore asset balance will reduce, because we sell off, we get money, will pay off the liability. So therefore benefits paid will be reduced from asset also, will be reduced from liability also. I hope we understood the interconnection between them. Then again the actuary will tell us how much closing balance of plan asset should be maintained. Suppose if there is a difference, again it will be considered as actuarial gain or actuarial loss. Even this will also be considered as actuarial gain or loss. Actuarial gain or loss will, if you take up both expected returns and actuarial gain or loss, that will actually give you the actual return. You expected 15,000 return, but there is an actuarial loss of 5,000, then automatically there is a less return to my fund, 10,000 what you can call. But I'm not saying this is 100% correct, because if the estimation changes at that time also, actuarial gain or loss will arise. So since it is an asset, actuarial gain I will add, actuarial loss I will deduct. If there is an actuarial gain, the asset value will increase. If there is an actuarial loss, the asset value will reduce. Okay, so I have an obligation to pay. For that I created an obligation account. The benefit I have to pay them. That after that you have got an asset to be created, because you need money to pay them. That will be called as plan asset. These two things run parallelly. So there is liability obligation and asset plan asset. So there is benefit obligation I have as liability, and there are plan assets. And according to AS 15, when you show this in the balance sheet, you need to show the net obligation, which means what I am supposed to do, the benefit obligation I have to pay, deduct the plan asset, what is the net obligation I have, that should be recorded as liability in the balance sheet. You will have different accounts in ledger, but balance sheet presentation will be the net figure. Okay, I hope till now it is clear. Let us take up some two more concepts now, which is related to this only. Once we are done with this, the defined benefit obligation will come to an end. The first one is the concept of past service cost. Okay, now what do we mean by past service cost? Suppose during the period of this defined benefit plan, if at all my employer makes any change in the terms, let's say in this example which I gave you, I told you that 25% of the last drawn salary will be paid. Let's assume that our employer wants to have more factors over here. So he said, no, I will pay you 30% of the last drawn salary. Not 25, but we will revise it to 30. Or else the increment we assumed was 20% throughout the period. But instead of 20%, he want to make it 30%. Any changes like this can happen. Now in this situation, what happens is, suddenly the obligation which I already had and obligation from today onwards will suddenly have a difference, and obligation future will be more now. Because either you have increased the increment rate, or you might have increased the last drawn salary rate. So any of the two might have got increased. So accordingly, suddenly what happens over there, there is a different obligation part itself. Okay, let's take an example. Because you made this, there is an additional obligation to pay to the extent of 20 lakh. Okay, we again called actuary and we told them that we are making the change, and accordingly tell me what to do. He said we may have to create an additional 20 lakh ka obligation. But let's assume that the overall period what we have is 10 years, and till now 4 years have been elapsed. Till now 4 years are elapsed. 10 years is the total life. Which means how many years are still remaining? 6 years are remaining. 20 lakh is the additional obligation I have. Now what will we think instead of creating 20 lakh right now, let us spread this 20 lakh over 6 years. Spread off this 20 lakh over 6 years. 1 year, this year we will recognize this year. Next 5 years we will recognize 5 years. And finally we can consider the revised value also. That gets added to original value where total value will come into the picture. So automatically what happened then? Automatically whenever there is a past service cost whereby the work has already been done, you are making the change to your defined benefit plan, automatically there is a change in obligation. That change, instead of providing right now, we will again spread it over different period, because this is also change in estimate. Change in estimate always runs on prospective basis. Okay, so the thing what you need to learn now is over 6 years, correct? So there is current year, there is next 5 years. Current year, out of 20 lakh, you take a part, again discounting will be done. You take one part and you consider it as current year expenditure. That will be called as amortized. Amortized past service cost. The next year's, future years through which you will be recognizing, that will be called as unamortized past service cost. Okay, amortized past service cost, unamortized past service cost. I hope we are clear. So what happened? There is a change in the defined benefit plan. Because there was a change in the defined benefit plan, automatically there is a change in liability. Even this is also spread over n number of years. So automatically whatever you have already recognized in that revision, that will be amortized part. What will be doing it in the future, that will be unamortized part. Okay, this is one concept we have to study. Amortized will come in P&L. Okay, unamortized means what? Unamortized is yet to be recognized. So you are not even recognizing it right now because it's not a part of this year. It will be a part of the future years. Okay, now when actuary will give me this after revision year ka liability to be created, what will be my actuary will be telling? Actuary will tell me the after making the change, which is basically the past service cost. After making the change, whatever should be the liability balance which we have to maintain, that will be declared by the actuary. Okay, now why am I specifying like this? Because what he will be doing, tell me, he will be giving me closing balance. What will be the closing balance? What he will give? It will be original, whatever original terms I had, plus whatever revised term I have. Combining these two, now he will give me the closing balance. Because I have told him that I have made the increment change from 20 to 30%. After making this change, he will tell how much closing balance you should have, which means it will contain the original balance, it will contain the revised mechanism also. This revised will have both amortized and unamortized. Correct? Because not all liability we are recognizing now. We are recognizing only a part of it. The rest will be spread over. But actuary doesn't care whether you are recognizing now or you are spreading it over. Actuary will tell, according to my calculation, this is what you should do. Therefore, when we show the liability in the balance sheet, it is not just obligation minus plan asset. It is obligation minus plan asset minus unamortized past service cost. Because unamortized past service cost is not even recognized in the books of accounts in the first place. Then it should not be a part of my liability. Okay, so this is the ultimate figures we are supposed to show in the balance sheet. I hope we are clear. So we have obligation whereby every year contribution will take place, interest will be added, benefits will be deducted, etc. That one thing we have. After that, there are plan assets. Because we invest in assets, we make all the changes over there. Then if there is any revision in the terms in the defined benefit plan, part of it you recognize, part of it you don't recognize, because you are spreading it over in the next year. In next year you will recognize, but not now. Therefore, unamortized past service cost will also be deducted. Okay, this is concept, additional concept number 1, which is past service cost. Amortized will go to P&L, unamortized will be deducted from the liability because it is not recognized. Second one is settlement and curtailment. This is the second additional concept. Once we learn this, defined benefit plan will come to an end. Settlement and curtailment. Now what happens over here is, suppose if it is settlement, then what happens is the employer will enter into a transaction in such a way that his future obligation will be reduced. Okay, I have an obligation, I agree, but I am entering into a transaction in such a way that my future obligation will be reduced completely or partly. Best example is commutation. Commutation of pension, if you imagine the concept, what happens there? Employee will decide to commute part of the pension and he will collect in lump sum. Suppose if he commutes 60% of the pension, in the future the employer have to pay only 40% of the pension, which means employer entered into a commutation transaction whereby in the future there will be reduction in the payment what they make. That is called as settlement. What do we mean by curtailment? Curtailment means the employer will make the revision to the defined benefit plan where it will reduce the liability. For example, he may reduce the benefits or he may reduce the employees also. Instead of saying only 5-year completed employees are eligible, now we might increase that to 20 years. So curtailment basically happens when the employer might be incurring losses, he may not pay that much. In all those cases, he will try to curtail it. Okay, curtailment can also happen. Now the thing is, for example, initially we had 50 lakh ka obligation. Because we entered into curtailment, the obligation will be reduced to 40 lakh. Okay, say 50 lakh will be paid after 5 years, but you told your employees that if you don't wait for 5 years, but if you want to avail it today itself, I can pay you, but I will pay you only 40 lakh because you want to save some money now. So accordingly, let's assume employees agreed. So automatically what happened? Liability got reduced by 10 lakh. Whatever net effect of curtailment takes place, that will be transferred to P&L. So P&L, whatever net effect on curtailment will take place, that will be transferred to P&L. Okay, but whenever you do this, suppose if there is an impact of past service cost also and curtailment also, at that time, whenever you take the net effect, always deduct the unamortized past service cost. Okay, curtailment will reduce your liability. Yes, that will lead to some profit right now because instead of paying 50 lakh, you are just supposed to pay 40 lakh. So it will create you a benefit of 10 lakh. But if that includes unamortized past service cost, that should be removed. In the exam, they will mention how much is the unamortized past service cost included in the curtailment. Okay, so this is about the settlement and curtailment concept. Now let us look into the chart to confirm whatever we studied is a part or not. Okay, let's start. So accounting in P&L, what will happen? Accounting in balance sheet, what will happen? So whatever example we studied there, let's try to apply those things in the chart what we have prepared so that we can easily connect to it. Current service cost will be a part of P&L. So can we remember this? What is current service cost? The yearly contribution which we make to the defined benefit plan after discounting so that we reach the level of payment at the end of the term. So that is current service cost, that will go to P&L. Interest cost will go to P&L. So if you remember that defined benefit obligation ka additions what we did, for the opening balance, interest gets added up. So that will be again an expenditure transferred to P&L. Then actuarial gain or loss. Suppose if there is a difference in the assumptions made leads to actuarial gain or loss, that will be a part here. So actuarial gain or loss, if we remember from the liability point of view, loss will be added, gain will be deducted. Gain or loss applicability in P&L also. Past service cost recognized in this year, so only amortized part we need. Unamortized not recognized, it will be recognized in the future. So that past service cost will come. Curtailment or settlement ka net effect, either it can be a gain or it can be a loss. So 50 lakh obligation, but if you pay right now, the employee said no, I was supposed to wait for 5 years, I would have got additional benefit. So now the employer said no, I'll pay you 55 lakh, but let's close it off. Employee said okay, so 5 lakh extra I have paid, that will lead to loss. Either it can be gain or it can be a loss. This is from the obligation point of view. All these things will be from obligation perspective, so these are technically your cost. Next, from the asset point of view, plan asset point of view, which leads to benefits, it can be expected return on plan asset and actuarial gain or loss on plan asset. So from that point of view, even these things will also go to P&L. If at all you are able to remember the examples we studied, all of these terms were covered over there. Okay. Next, in the balance sheet, what will happen? In the balance sheet, the way we show it is defined benefit obligation minus past service cost not recognized, which is unamortized, then fair value of plan assets. As I have told you, net of we show, so liability minus asset we show, then minus past service cost unamortized because it is yet to be recognized. This will be my net disclosure in the balance sheet. But how do you get individually now? How do you get DBO? Defined benefit obligation, there is opening balance, add interest, add current service cost, less benefits paid, then actuarial gain or loss we discussed, leads to closing balance. If closing balance is available, the balancing figure will be gain or loss. How do you get plan asset? Again opening balance, add interest, which is the expected return, then current year contribution we make, benefits paid is deducted, again actuarial gain or loss leading to closing balance. This is how you consider the liability perspective. For these two deduction, also deduct unamortized past service cost. You are going to get your final valuation to be disclosed in the balance sheet. Okay, I hope things are clear. Okay, do let me know in the comment section or you can text me up so that I can come to know whether you are able to understand this or not. Okay, your feedback matters a lot. Now just some additional part just to understand what it is all about. So actuarial gain or loss, either due to experience adjustment or change in assumption, it might lead. Okay, I might tell him a different assumption in year 1 and it might have a different assumption in year 2 because of the circumstance changes or experience adjustment. There will be an actuarial gain or loss immediately transferred to P&L. We have already discussed about it. Then settlement, the transaction eliminates all future legal obligation, commutation of pension, what we discussed. Curtailment, reduction of benefits from the plan. You reduce the benefit, you will consider the payment right now, so the net impact will go to P&L but deduct unamortized past service cost. So gain or loss to be recognized minus proportionate share of unamortized past service cost is the net gain or loss which will be shifted to P&L. Okay, so this is about the defined benefit plan. When we take up the question, we'll learn this correctly and in detail so that it will be helpful for us. Okay, next, other things are quite simple now. It's a 2-minute job so that we'll learn this correctly. Short term and post employment benefit are the most important ones. That too in this defined benefit plan is most important one. Okay, other long term employee benefit, recognition and measurement is same as defined benefit plan, no changes. Okay, what is covered? First of all, the payment will be made after 12 months or spread over after 12 months. So because of this, it will not be called as short term, it will be long term, and accordingly the measurement and everything will be done according to DBP. Then termination employment benefit, you are allowed to recognize the termination employment benefit only if the formal plan related to this termination is approved. So there is a board of director meeting, they have approved this layoff, what we normally call, which is happening in day-to-day life nowadays. So there has to be a formal plan first and there have to be a reliable estimate of how much terminated benefits we are supposed to pay. If both these things are available, then only you will consider the termination employee benefit, otherwise no. Okay, they are still in talks, but that is not going to happen, or there is a probability of not happening also. At that time, no. There have to be a formal plan so that it can be implemented. Okay. Next, if the termination benefit is due within 12 months, then don't discount it. If it is more than 12 months, then apply discounting. Generally, termination benefit will be within 12 months only, because of which discounting will not be applicable. But in certain exceptional circumstances, it can go beyond 12 months. At that time, apply discounting. So this is all about how do you consider AS 15. Okay, so if we start recalling what happens in AS 15, first we learnt about coverage, correct? Where we said all employees are covered, all types of employee benefits are covered. Only exception is employee stock option plan. When you consider the coverage of employees, formal EE relationship may not be there. Informal is also covered. but contract of service is covered, but contract for service is not covered. That we learnt in coverage. Then we learnt about types of employee benefit, where there was short term, there was post employment, there was long term, and there was termination. Four things we started studying. Short term had general rules where we said transfer it to P&L, undiscounted, any change in payment, then asset or liability to be created. Then compensated absences, where compensated absences had accumulating, non-accumulating. Accumulating had vesting and non-vesting, where accumulating will have a additional cost, vesting you will consider full cost, non-vesting you will consider estimated cost based on probability of how many people will avail the leave in the future. Then we spoke about bonus, where you need to have present obligation and there has to be a reliable estimate. After that, we studied about post-employment benefit, where there were two things, DCP, which is based on contribution, and DBP, which was based on all the fund mechanism, where DBP we said in balance sheet consider benefit obligation minus plan asset minus unamortized past service cost. P&L we had a list, that list anyhow we have studied before. Then long term you have to follow DBP, termination you have to apply only if there is a formal plan and there is a reliable estimate. So these are the factors we studied and accounting was done accordingly. Okay, I hope we are able to understand this, sir. If any feedback or anything you want to say, my contact is there in the description window. You can look into it and let me know. See whether it is understandable or not. If yes, please share this with your friends also. Okay, now we will look into certain problems based on this, so that whatever studies we have done will be clear of. Okay, certain questions I have picked it from either the institute material or the RTP. So let's look into it quickly. Hello Limited belongs to the manufacturing industry. The company received an actuarial valuation for the first time for its pension scheme, which revealed a surplus of rupees 12 lakh. It wants to spread the same over the next 2 years by reducing the annual contribution to 4 lakh instead of rupees 10 lakh. The average remaining life of the employees is estimated to be 6 years. You are required to advise the company on the following items from the viewpoint of finalization of accounts, taking note of the mandatory accounting standards. Okay. Now, the company received an actuarial valuation for the first time, which revealed a surplus of 12 lakh. Now, this 12 lakh, instead of recording it now, the company wants to spread the same over the next 2 years by reducing the annual contribution to 4 lakh. Now what they are saying is, anyhow there is 12 lakh surplus, I want to take it for the next 2 years. My yearly contribution is actually 10 lakh. 12 lakh is surplus. I will adjust that as negative 6 lakh for year 1, negative 6 lakh for year 2. I will now only transfer 4 lakh in the next 2 years. This year I don't want to do anything about it. Now they are saying whether this is correct or not. But actually this 12 lakh will be what? Actuarial gain. Any change in the valuation due to actuarial calculations, that will come under actuarial gain or loss. What have we studied in AS 15? We studied that actuarial gain or loss should be immediately transferred to P&L. So therefore, automatically you can't spread this over. The entire 12 lakh will be recognized now itself. So look into the solution. According to AS 15, actuarial gains and losses should be recognized immediately in the statement of P&L. Therefore, surplus of 12 lakh is required to be credited to P&L statement of the current year itself. Don't spread it over, because actuarial gain or loss according to AS 15 immediately recognize. Next, this is illustration 8 in our study material. Rockstar Limited discontinues a business segment. Under the agreement with employees union, the employees of the discontinued segment will earn no further benefit. What do we mean by this? Curtailment. Because we are reducing the number of employees, they will not be covered under the benefit plan. This is a curtailment without settlement, because employees will continue to receive benefit for services rendered before discontinuance of the business. Okay. Curtailment reduces the gross obligation for various reasons, including change in actuarial assumption made before curtailment. If the benefits are determined based on the last pay drawn by employees, the gross obligation reduces after the curtailment because the last pay earlier assumed is no longer valid. Rockstar Limited estimates the share of unamortized past service cost that relates to the part of the obligation at rupees 18. Calculate the gain from curtailment and liability after curtailment to be recognized in the balance sheet of Rockstar Limited on the basis of given info. Immediately before the curtailment, gross obligation was 6,000. The fair value of plan asset was 5100. Unamortized past service cost is 180. Curtailment reduces the obligation by 600, which is 10% of the gross obligation. Curtailment is happening, because of which the liability will be reduced. Liability reduction, they are mentioning that it will be reduced by 600. Unamortized past service cost is 180. 10% is getting reduced. Okay, that is the scenario which is happening. Because 600 liability is reducing, I can say that it is gain on curtailment. Because whatever liability is reducing, as discussed before, is supposed to be my gain now. But when you consider this gain, what we need to consider, if there is any unamortized past service cost, proportionate value should be reduced to get the net gain. Unamortized past service cost relating to the part of obligation is 18. So 600 minus 18, which will be 582, that will be our net gain. Okay, so that is what we have it here. 582 is our net gain. What will happen to our liability balance, or what will happen to our balance sheet production now? See, balance sheet, what we are supposed to do? The benefit obligation minus plan asset minus unamortized past service cost. Correct? Now, benefit obligation initially was 6,000, but it's getting reduced by 600. So, how much will remain then? We will have 5,400 balance remaining. Then how much is plan asset over here? 5100, that has to be reduced. Then unamortized past service cost. We have a total of 180 unamortized past service cost, but out of that 18 rupees got reduced now because it was a part of curtailment. So how much is still remaining then? 162 is still remaining. 180 minus 18. That will become your net obligation. See, 5,400 minus 5,100 minus 162. This final obligation will be shown in the balance sheet. I hope we are clear with this. Next, the next illustration which we have, an employee Roshan has joined a company XYZ Limited in the year 21. The annual emoluments of Roshan as decided is 1490-210. The company also has a policy of giving a lump sum payment of 25% of last drawn annual salary of the employee for each completed year of service if the employee retires after completing minimum 5 years of service. The salary of Roshan is expected to be grown at 10% per annum. That is our increment. The company has inducted Roshan in the beginning of the year, and it is expected that he will complete the minimum 5-year term before retiring. Thus, he will get 5 yearly increment. What is the amount of company should charge in its P&L account every year as cost for the defined benefit obligation? Also calculate current service cost and interest cost to be charged per year, assuming a discount rate of 8%. Okay, this is the question given for us. So basically his initial salary is 1490-210. Correct? That is the initial salary. There will be a 5-year term, 10% increment. If at all we keep on adding it for 5 years, we are going to get the total amount of salary at the end of last year. That will be the last drawn salary. According to the question, last drawn salary into 25% is supposed to be paid. So that amount will be recognized over a period of 5 years. That will answer your first part. What should be the total charge in its P&L divided by 5? However, whether you will put all the money in the same way for 5 years? No. Because year 1, end you are going to contribute or you are going to apply it for obligation, but year 5 is the payment date. So gap is 4 years, so 4-year discounting, 3-year discounting, 2-year discounting, 1-year discounting, 0. So in this way discounting factors will apply, and for that discounting rate is 8%, correct? Yes, discount rate is 8%, and the question itself has given us the 5 years ka discounting, not 5 year, 4 year, last year anyhow it will be 1. So if you now look into it, 110% they have multiplied it 5 times because 10% increment every year. So that will come to 24 lakh. Of this 25% will be paid for 5 years. So 30 lakh is the total amount we are supposed to pay for each completed year of service. Divided by 5 will be 6 lakh. 6 lakh should be spread over the period of 5 years. But whether you will put 6 lakh every year, no. That will be multiplied with the discounting factors. So this will be our current service cost. As discussed, each of them will have its interest, will lead to closing balance, and automatically on this closing balance, interest will come into the picture. We have discussed that in our example. Normally, the last year interest will be adjusted because of the balances what we consider, because of the change in the percentages what we take up, appropriation differences. So that's how you are supposed to deal with the questions based on AS 15. Okay, I hope whatever we studied now is clear. We are able to understand whatever is happening in AS 15. A lot of you had asked me about this AS, so this is how it goes. I hope everybody understood this. Please provide your feedback as to whether we are able to understand this or not. For all these new accounting standards, if it is related to each other, I will group them, or I want to share it as a separate video so that you are able to only look into that AS and then change the AS and look into the next one. Already old ASs have already been considered and it has been uploaded in one or the other session. Please have a look into that as well. And any doubts, you can come back to me and we can discuss about it so that it will be easy for you. Okay, so happy studying, all the very best with this regard. With this, we will complete the AS 15 discussion.